What are the key things that jump out at you in the first few minutes of looking at this report, Jesse?
So the Fed is painting a pretty rosy picture. They're talking about how well capitalized banks are. Leverage is very low at Wall Street securities firms. But the risks are the same risks the Fed and others have been citing for a while. Leverage loans. They talk about how businesses, U.S. businesses, are taking on debt at historically high levels. And investor appetite for those loans is higher than the Fed thinks it should be. So there's a lot of warnings in there that, you know, if there's political uncertainty, trade tensions escalate, and we get an economic slump, those kind of assets, in particular, the leverage loans, could fall pretty precipitously for the reason that the Fed thinks they're overvalued and investors are ignoring a lot of the risks.
Are we getting any recommendations out of this report, or is it just a snapshot of what the Fed sees, Jesse?
It's really the latter there. There aren't recommendations. What this could be is a tool. There's this thing called the counter-cyclical capital buffer. Try to say that quickly. That banks banks are supposed to set aside more capital when times are good to sort of cushion losses when things go bad. And this is one of the tools that the Fed would decide on whether to trigger that buffer. Banks really don't want it to be triggered. They never want to hold more capital because that cuts into their earnings. But the Fed is not there yet, and they're probably not going to trigger that buffer.
Jesse, the Fed says that investors are exhibiting, quote, high tolerance for risk. Is that the same as irrational exuberance?
Well, I think that is sort of the Fed's way of using a euphemism to say it's not risk that we're comfortable with. I mean, back to the leverage loan argument, I think that's one in particular where they really have a lot of concerns that investors aren't getting the safeguards they could in that market. As lenders remove safeguards, you know, make collateral less friendly to investors, whatnot, investors continue to pile into that debt, and I think the Fed is concerned about that.
Jesse, the Fed has dual mandates. This is one of them. The other one, obviously, is price stability. How does one bleed into the other?
Well, I suppose that, I mean, if businesses are taking on a lot of debt, they are employing people, so that's part of the mandate, you know, full employment. But I think the Fed is increasingly concerned that a lot of these loans aren't safe. A lot of these companies could go belly up, so that affects the mandate too. I mean, if these businesses have to lay off a lot of people in a downturn, that's not a good thing from the Fed's perspective.